My name is Prabhu Rangarajan. I'm the co-founder of M2P FinTech. Madhu and Muthu are my other co-founders. So how this started, okay, இது வந்து ஒரு சாய் சாய் கடையில் தான் நாயர் சாயா அதில் தான் ஸ்டார்ட் ஆச்சு, ரைட்? Madhu and Muthu were working with Visa, the payment network. So they were based out of Mumbai back then. This was 2012-13 when Muthu joined. He wanted to basically, he was working in Singapore and he wanted to come back to India. And Madhu was working with Citibank till about 2009, and then he moved to Mumbai, right? ரெண்டு தமிழ் பசங்க, ஓகே. ஸோ டீ குடிக்க வாஷ்ரூம்லேருந்து டீ குடிக்கிறது எல்லாத்துக்குமே வந்து ஒன்றா தான் போவாங்க, கரெக்டாக? ஸோ I mean, these two guys were conversing on and off about, the problems in the market and all that, right? If you see Visa or MasterCard, these two are behemoths in the payments industry, right? They basically own almost 90% of the payments market. And then there are companies like PayPal and, Discover, JCB and all other card networks. But Visa, MasterCard basically owns the payments piece. So being part of Visa, they were able to see the entire market in a 360-degree view. And India was new to the, adopting digital payments, right? Like India basically started only after liberalization in 91-92. Visa, MasterCard became big in India. And we started issuing debit cards, credit cards and all that. And then by the time it became mainstream, right, what happened was there were two major players, right? On one end, there is the regulated entities like banks, financial institutions like NBFCs, prepaid instrument providers, forex money changers and all. And then on the other side, there are companies which were working with these finance companies to offer cutting edge products, right? Say for instance, I'll take some examples, right? Like let's say Slice or Tamil Nadu based Pay or any startup that wanted to launch payment products, they have to work with a regulated player because that's the rule of the land here, right? So it has to be an RBI regulated entity. So the gap was wide. What banks had to offer as technology and what companies want to actually take it out to the customers was completely different. And I'm talking about the post-iPhone era, right? Say for instance, pre-2007, you did not have smartphones in a democratic way, right? Like smartphones were very expensive, only the elite were able to afford it. But between 2007 to 11 or 12, you started seeing Android also got big. The smartphones became democratic, right? Everybody from milkman to CEO, everybody had an iPhone or iPhone equivalent Android phone in their palm, right? That was the beginning of the digitization journey. Everybody started thinking about digitization, and of course, banking was part of everybody's lives. So banking had to be digitized, right? And then even RBI and Banking Association and all these players started, creating consortiums for offering that. Like NPCI, which is National Payments Corporation of India, was formed around early 2000s, and then they started shipping out products that were specifically to address analog to digital transformation, right? And then they came up with this concept called IMPS. All of you use that now, right? And all of you use UPI today. So UPI, IMPS, or Google Pay, Phone Pay, whatever you use today, it's a product of NPCI, right? So yeah, the regulator was thinking about digitizing stuff, but again, the accessibility to it was a missing piece. That was the white space that we wanted to kind of get into, right? Somebody had to partner with a regulated rate, with a company like NPCI or a consortium like NPCI, and build a layer that will connect end to the other end, right? That was how M2P was born. And of course, I joined the party in 2014. By when the three of us kind of met and discussed what can we do, how can we, get this going and all that. We thought like, okay, this is not like a simple problem. We have to start small somewhere. And then we identify a few pockets, how to kind of, go to the market. And then we put in our own money. I basically sold the flat that I owned and, got some startup cash. And Madhu and Muthu also basically gave all their retirals and stuff, pushed it towards forming M2P, right? So M2P was formed in late 2014. We started as a very small player, basically an API layer that was basically getting the bank's APIs or bank's core banking and, other pieces. And, offering those APIs to the other end. of the spectrum, right? This was 2014, late 2014. By the time we hit the market, it was 2015. And then we decided to be bootstrapped for a while till we, find our feet and basically get some traction. Okay, there are 3 or 4 reasons to it. We thought what we are doing is like market creation. When I say market creation, there are companies like Book My Show, BillDesk, or Make My Trip, and Redbus, right? If you see each of these companies, they have created a market for each of these industries, right? Let's take Redbus for instance, right? The founding team basically went to every bus station, like in Coimbatore, there is Ukkadam, or the other bus stand, I forgot the name, the Omni bus stand. They basically went there. In Chennai, they went to the Mofussil bus terminus or the Omni bus stand close to the CMBT, right? So they went there with laptops to basically key in whenever there was a ticket, there was like basically a chit, right? Or a chinna seat right? They did that. They started keying in the ticketing, and then they went and deployed a dabba in every ticketing office of the bus service providers. That was market creation, right? And then for everybody else, like today you can book using Paytm or any super app today. Bus booking is easy, but somebody had to do that analog to digital transformation somewhere, right? Redbus did that for the bus industry. Make My Trip did that for the travel industry. Book My Show did that for the movie or cinema industry, right? So similarly, M2P basically did that for the banking industry, right? We had to kind of go to every bank and say what you have is not usable by the companies. So we will deploy a dabba in your bank only, or maybe we will give it as SaaS. At that time, SaaS was not a term, and fintech was not a term, right? We created that market, and we said, okay, we'll do that. We'll do the hard yards and get probably good set of companies to partner with you, and you can also see some affiliate revenues. Like for banking, if you see the main revenues are CASA. CASA means current account and savings account. So that's the major business for any bank, because that is their liabilities business. Using that money, what you, me, and everybody keeps in a bank as savings or FD or anything, they take that money and lend to somebody else, right? That is their asset business, right? So it is like a chicken and egg problem. Without getting liabilities book built up, they can't actually build assets, right? And they were always busy with it. And they had non-performing assets. There was always some scam or the other. So it was always a tough job. So they never had time to kind of think about digitization, think about offering to co-brand partners, and they did not even feel that fintech companies are even a sizable portion of their business, right? Which is what we wanted to change. Today, fintech is like one of the most highly invested, I would say probably the top invested domain, VC funding or private equity funding or any sort of like debt funding. That's probably the top beyond the regular industries. But yeah, I mean, that's where we wanted to play a big role. So today we call ourselves as a banking as a service provider or a fintech infrastructure provider. Back then, infrastructure was not a word that we really coined for ourselves. Okay, and what we did was that, one second, I'm reading up. So what we basically did is to start small. We decided we'll be bootstrapped. We'll not take any external money because we did not even know what we are creating. Okay, but we knew that there is a market. So the biggest learning was market is the only truth for any product. So we built a product. We thought there is a big problem in the market for a merchant facing business. And then when we hit the market, it was not even a problem. Okay, we threw the entire code base to dustbin and started all over again. By 2015 mid, we had another product which was basically solving a very small problem. And then that became so relevant because RBI also started pushing, and then the government changed. BJP came into power. They started pushing digital payments. They started incentivizing banks to adopt digital payments. And a year later, UPI came across. And then RuPay became a big payment network in India. They started challenging Visa, MasterCard. And then by mid of 2016 or late 2016, we started realizing that being a layer on top of somebody else's tech, whether it is a bank tech or a fintech, is of no use. we had to be a vertical player where we have full vertical integration. When I mean vertical integration, how do you actually uh, make each and every component that actually powers your payment? How do you actually own most of these pieces, right? That's when we started calling ourselves an infrastructure player, where we started building the base infra, the railroad on top of which the payment, engines run. So we started working with NPCI, we started working with Visa, Mastercard, built the payment network connectivity in-house. For almost 2 years, we built these railroads, and we were under the radar completely. Just rewind 5, 6 years ago, you wouldn't even know, you wouldn't have even heard M2P as a brand name or a company name. And then by 2018 or 19, we had a dichotomy. Should we take the services approach where you can be called as a software vendor, or should you take a product approach? Okay, that was our second pivot. Okay, we said no, we do not want to compete with the likes of FS or Euronet or FSS or anybody in the market. Let's build products, because the the challenge in banking is not just lack of digitization. It is also the lack of replacement of archaic and legacy products, software, right? So we started building products, and then the realization was that by then we had tried out a lot of stuff. We tried doing the QR story. We tried going to merchants, and basically, if you don't go with the bank, the merchants will basically say, "Get out of my shop," and stuff like that. We have seen the market. We have understood that. Being a B2C or a direct to customer business is super hard. So we stuck to our basics. We thought we can't really solve every problem on earth. Let's build tools. Let's build some platform components which can be extended by people and then the companies that actually own the customer acquisition and everything. And then let them go to the market. Let us just be the player that powers the innovators. Okay. While we innovate, our innovation is used by some other innovator to actually meet the customer. Okay, so this was largely the journey, and from then on, like from 2018 onwards, we've built a lot of products like credit, debit, prepaid. So today, let's say for instance, TVS Group gets a banking license today. They don't have to write one line of code today. They can go live on our platform in 3 to 6 months based on their requirements. They can just use our platform, like from front ends to apps to whatever, right? A TVS Bank can run on M2P stack, from core banking, ledgering, financing, accounting, all the way till card issuing, mobile banking, whatever you need, a company might need, we have that as a software stack, and all of this is SaaS. Okay, and that was another problem. Why banks did not want to kind of be pro partnership is mainly because of the software cost. Most of these banks, you guys would have known about Infosys, Finacle, or Oracle has this core banking called FlexCube, or there are imported, or I would say foreign companies that offer these products like Tap Machine or Mambu. All of these are super expensive, hyper expensive, right? It's like I'm talking about a simple core banking license costs about $1 million a year, right? How many banks in India can offer 7 or 10 crores a year just for the software, right? Just the basic ledger. So with that, this has to kind of be intervened. We thought we'll disrupt this by offering it as SaaS. So all these stuff that we have built so far, it's a product. All of these are APIs, and each of these can be taken in a SaaS kind of a model. You pay a one-time fee for sign up, and then you pay as you go. Like as transactions rise, as volumes pick up, we have tiered pricing, and that's how we have built our revenue base. And I'll also probably take a minute. I don't know how much time I have left. I remember Vinod said 20 minutes. I think we are well within the time. So what we've done to give you a perspective, if we were a bank, if all the transactions that are run using the M2P software, we would be the 5th largest bank in India. Okay, in terms of volume. So that's the perspective, right? And the other part is that what do we want to do? Like what's our vision? Why are we doing this? And where do we want to get to? That's to simply put, I believe we should build a financially inclusive universe. Okay, I'm not stopping at the world. okay? Because 2-3 years ago, I was always mentioning about world, okay? And then I stopped mentioning world because all of us know, like many startups like Agnikul from India, ISRO, and then SpaceX in the US, all of us are trying to get to Mars. And then probably in our lifetime, we'll probably send people to Jupiter and so on, right? So I'm including the entire universe. And then what we think is that uh, wherever there is commerce, wherever there is trade happening, there is scope for money movement, and then wherever there is money movement, there is scope for technology to intervene, and that's exactly what fintech means, right? Fintech is basically connecting finance with tech. Yeah, were you saying something?
Bro, that's good. You're still within the time.
Yeah.
And even I guess the question that I asked you under. I don't know that any of that.
Yeah, absolutely. Okay. So, I spoke about the M2P journey, what we do, what are we building, and where are we going, or where are we heading towards. Now, I'll answer the other part, right? So, I'm not going to say anti-VC and all the while till we basically were able to find market fit to our product, we thought we should be bootstrapped. And that's something I believe every founder who believes in his idea and has the ability to execute it has to do it. Because unless you put in your own money, you'll not have the urge or incentive to make it work, right? If it is somebody else's money, you basically are not as responsible as your own. So that's a very, very fundamental thought process. And it's generally, I'm a Tambran. Generally, if you see anybody from Tamil Nadu, take Naidus or, the Chettiar families or any, I'm not trying to bring in caste here, but I'm saying these people have built a legacy of building very, very strong businesses. Like let's take Murugappa Group, for instance. They did not raise VC funding actually to build the business. They got to some stage and then started taking money or investor money to only expand the business, right? I think that's exactly what we have done as well. And then there are, even today, if you see companies like Zoho are there who are fully bootstrapped. Okay, it works for Zoho, but they've spent 25 years, right? Today, everybody talks about Zoho when they're at a billion dollar valuation or billion-dollar revenue, but nobody gave them a chance when 15 years ago when they were probably at a 50, 60 mil or 100 mil kind of revenue, right? They thought like they're making a mistake, they're not taking external money, right? So if you have 25 years, you can run it as a lifestyle business, you can be bootstrapped. But if you don't have that time, you want to kind of, not everybody can be Sridhar Vembu, right? If you want to kind of scale your business after finding product market fit, you have to scale your business to actually realize the potential, right? For that, definitely external capital is required. And that's where VCs play a big role. And I'm humbled to say this, we've been extremely lucky to have found a book, or I would say an array of investors who've been super supportive on our idea, understood our market, and know that they have to be patient for us to actually realize our potential. Okay. So what we did was we tried raising. So all the way from 2014 till 2020, we were bootstrapped. But when, as I mentioned, by 2018, we had started building products. We thought these products have a lot of relevance overseas, not just India. Like a card issuing, like a credit card or a debit card, works exactly in the same way like how it works in India. If you go to Indonesia, it's the same thing. If you go to Dubai, it's the same thing, right? Like you don't really do anything different to make a payment using your card. Okay, so we thought we have built something that works in India where everybody asks everything for free, which means you have actually attained the best value for money in terms of cost proposition. And then you can actually export it out to other markets. But what happens is that there is a problem, right? Like we were at a very small revenue run rate, sub $1 million run rate. And we really can't afford to spend money earned in India in INR as USD overseas, right? The math will never add up. So that's when we started putting in a kind of a framework to go and fundraise and go to VCs, get their money to deploy in multiple markets, right? So we had a show-and-tell effect of the market in India, and then we saw opportunities like say for instance, Dubai is like the 2015 of India, right? Or India of 2015, right? There is no UPI today, but card payments and everything is full blown. But for them to adopt a UPI-like framework, it is at least 5 years away. Okay. So that's our opportunity. So that's when we went to VCs. And then whole of 2019, we spoke to all the major VCs. We thought, I would say too much about ourselves. We thought like we are super interesting as a business. I think we can just go ask any money and anybody will give. That's all. That's how we thought. We were actually very, I would say, mildly arrogant, right? But the reality was that nobody understood the market. VCs really could not build the conviction to say, yes, this is a $10 million business or a $100 million business or a $1 billion business. So we could not raise any money. We did not get any term sheet. Or the term sheets that we got was not even meeting our fund valuation kind of requirements, because we were at a $1 million plus valuation. Somebody values at us 5 million or something. It was like too little, and we had to let go of a lot of stake. So we decided to then, we came back again, pivoted our approach, went to people who are industry veterans. We went to Amrish Rao, Jitin Gupta, Kunal Shah. All of these guys have built a payment company and exited successfully. And they understood where we are coming from, right? And then these guys together, we put together 10 crore round, and then they came in. And then I'd say we have done 4 or 5 rounds after that seed round. And the rest is history, right? Like all of this, you know that it's in the news all the time. But what we did was going to a VC and asking for large sums of money without having the numbers backing it is a no-no, right? It is not a VC problem. It is basically the founder's problem. And after you get that, after you get the money, show the real deployment plan. What are you going to do with the money? It's not like I'll build a fancy office. I'll give all the benefits to my employees, like I give free bikes, free trip to Dubai, and all these. These things are not what VCs want you to do. They basically want you to show that if I give you these money dollars, okay, if you are growing at 1x, can you grow at 5x in a given period? That's the question they keep asking, and they ask it to themselves. Like VCs undergo a process called investment committee, and there are a lot of back and forth work that they do. They also do some due diligence and legal framework and stuff like that. But the underlying part is to build conviction. They have to know what is that multiplier effect that their money can do to your business. Okay, this is I would say the foundation of why external money is required. And then I think the second part was basically, I think when I discussed, was basically how do you use the money? How do you deploy? How do you plan to use the money? Right? I've built a B2B business, and I'm not so good at B2C businesses, so I'll talk more about B2B businesses. But we do work with a lot of B2C business. I can tell you some experiences that I've seen that the fellow founders have done. Right? So in terms of deployment, why VCs want to back your deployment plan or your business plan and not the existing story is mainly because your valuation is always in a projected manner. There is this valuation concept called DCF, which is a discounted cash flow concept. Most of you would have gone through that. Your auditor would have given you that valuation rating. It is basically like, what do you call it? It's like getting a valuation out of thin air, right? The projection, whether it will work or not, do you have the team to execute it, do it? Do you have record of growing at such pace? Doesn't matter, right? So that projection has to make sense. Can this money that they deploy will be able to catapult your business to do that is the question, right? And then once you get the valuation and everything in place, let's say you get the money, what is so important is how your deployment plan is closely linked with your projections. Okay, so the deployment plan. So what we had, I'll share my experience. When we raised our first seed round, the 10 crore round, our development plan was very simple. We did not tell them that we need actually $10 million, but we are only taking $1 million today. We broke down the larger round into multiple smaller rounds. We said, I'll get this. In 6 months, I'll show this traction, or in 1 year, I'll show this traction. I'll hit this number. Then I'll start raising more money at a higher valuation because my numbers have increased. Right? That's exactly what we did. We basically did a revenue multiple on our valuation. And then we grew almost like 4x from 2019-20, another 4x in 2021, another 3x or 4x in 2022, despite the base getting bigger. And our money sizes or the revenue sizes also actually started multiplying. We were at probably around $1 million run rate back then, and then now you can apply the multiples, right? Like our revenues are hitting towards becoming $100 million company very soon. So, and our valuations also followed along, right? Like we were valued at $10 million in our seed round, and now we are valued at close to a billion or a unicorn kind of status. Now, the deployment plan, right? With each of these rounds, what we did was we showed a clear path towards what are we going to do with the money. We had two approaches. One was the global expansion piece. Exactly when we raised funding, COVID happened. So the global expansion took a big beating. That's when we pivoted and said, okay, I'll use this money to acquire companies. Let me not just build everything in-house, because I only had a 50-60 member team till March of 2020. We are 1,200 now, but consider March 2020 M2P, it was a 60 member team. I can't build every software on it, right? In the banking world at least. So we started looking at adjacent opportunities where we had all of what it takes to do card issuing and do a credit card or prepaid card or forex card and stuff like that. But we did not have the core tech around lending or how banking works, like the core banking product or the core KYC product, because each and everything in banking requires a KYC piece, right? So in the last 2.5 years, despite having COVID, we acquired about 8 companies. We fully acquired 6 companies and then had large major stake or strategic interest in 2 companies. So this started paving way for us to be called as a banking operating system of sorts, right? So our product got stronger. Then when the markets opened up, we were able to start traveling and go global, and we are live in 20 markets today. So even if I raise another round of funding today, okay, the plan will be again two-pronged. One, to acquire more companies or acquire more capabilities. Two is to see newer markets where we are still not available. I would say not expanded into North America yet. All of you know North America is like, anybody has this American dream. So from North America is still a while away. So if we do another round of funding, we'll clearly show what are the plans that we have with North America, right? Or maybe Europe or UK or some other market, right? So that is how you'll have to probably plan the fundraise. And investors are also, sorry to say this, investors are also not just investors, right? They are basically trading something. What are they trading with? Private investors like PE investors or VC investors generally trade something called as private equity of the company, right? They buy your company shares at an X price. They're doing that because they believe strongly that your share at X price will become 5x, 10x in a given period, right? So they're basically traders, right? So you have to show that progress and the deployment plan has to match with that pricing and trading part also. So I'll probably pause here. I know there is too much to take in a 15-20 minutes.
Thanks for that. So just summarizing, you're saying get to product market fit before you jump into raising any money, and also raise money when your plans are super clear and you can grow. And then you're saying VCs are traders. Thanks.
So and I'll also just to I was always talking look more like or sounded more like I'm against VCs.
No, I'm just joking, Prabhu.
Yeah. One good part, right? Like let me tell you, there are a lot of taboos in the market that taking money from VCs will actually create some friction and you can't really execute what you want. And the other part is that there is one fear that VCs will intervene in your business and all that. I would say it is somebody actually not promising you around, at least actually having a leash and trying to make you get disciplined. Discipline is where Indian businesses go wrong. Why 98% startups fail? Because there is nobody actually questioning you on why you do this. There is no talent to the business. Okay? And then VCs are there, they're basically getting you into a structure where you have to do quarterly reporting, whether they go revenue or not. However, it is the money. If you are a D2C company, how will you market it? Is a marketing working or not? It's easy for everybody to say, I'll go do Google ads or Facebook ads and stuff like that. Is it working? Somebody has to then measure that. VCs are the best to come and tell you this worked in such companies elsewhere because they have a global outlook and they give you that. Like I would say, they act like an R&D department for you, in some sense, right? That is not appreciated in the Indian market at all, right? They think like people are asking questions, and only when you are asked questions, you will get to deeply think about answers, and that's a discipline part, right? You get discipline, you start counting a number of revenue. Today, like you read on my laptop, our P&L will be open at all times. An Excel sheet will be open at all times, right? We started like, I would say, but when we were bootstrapped, it was not the case. Right? When we were bootstrapped, it's okay. If we lost money, it was okay. We will always think to ourselves that we can always regain that. But when there are somebody who is actually watching it, not that they are questioning or policing, it's just that you have that extra sense of,
Responsibility, yeah.
right, responsibility, that you start applying and you basically get disciplined. So that's about it.
So I'll ask the audience, questions. I want them to take up a couple of questions. Feel free, we have someone. Yes, please go ahead. Just say your name. Speak a little loud. I'm hoping Prabhu can hear. Please go ahead.
Sure. Prabhu, Arvind from Litmus. So almost everything, like the similar kind of thesis that you built for banking, we're building for schools. Archaic, old age systems where like resistance to digitization, all of these things we're facing. I had a couple of questions. One was when you started reaching out to banks who were in a position of power to reject you essentially, what worked for you for those first few conversations that helped you sell like an ancillary business that they weren't appreciating? Romba value varunu edirpaakada business irundada. How are you able to upsell or like get them to buy in and overcome that resistance, overcome the inertia? Second part is, we are bootstrapped as well. We face very similar kinds of situations as you. Until you were able to get the ball rolling and show revenue, can I understand that you weren't able to raise money, and that's a reasonably good path for us as well?
Sure. Great. Okay, I'll answer that in two parts. Okay. I told you market is the only truth, right? There is also another truth. Okay. For a product, the market is the only truth. Take your product to the market, come what may. The MVP can be negotiated. You can say what is my minimum viable product, but hitting the market is a mandatory item. Can you go to the market in 3 months, 6 months, even if 2 customers use your product, if you are able to take feedback and go to the investor with something that is tangible, that's important, right? That will actually give you a lot of assurance that what you have done is good work. Even if one customer or one life is changed because of your product, that's still it means a lot. So for the product, market is the only truth. For business, numbers will be the will remain the only truth. Whatever you do, like how much of a popular you are, right? You can be replaced in no time, like Nokia, or there are a number of stories. I don't want to go into you guys with stories, but the thing is that if you are a revenue generating business, the numbers have to kind of tell the story themselves, right? And offtakes is very important when you actually go to raise funding from external people, because they have to understand. These are not SaaS experts. These are not FinTech experts. These are not probably, I don't know what industry you are in, but they're not, let's say you are building a food company. They might not be a food tech expert, but they will be experts in assessing the market and assessing the money or the numbers that you show them, right? So keeping these two things in mind. Now I'll go back to the first part of your question. When banks, how did banks believe us, right? Again, it's the same thing. We show them a market and the product which can actually show the fit for the market, and then we do not go with empty hands. We basically take the customer along with them. I'm telling you, it's a new public information. I'm telling you the first bank and first customer we launched. So thanks to Madhu, he had very good relationship with Visa. He was the prepaid, I'd say head of product for prepaid in India and Southeast Asia. So we worked with most of the CXOs in banks, right? So what we went to banks with is a product which you can launch, and we took IAFL as a customer along with it. We basically did a prepaid card for, let's say you take a gold chain and go and pledge in an IAFL or a Muthoot branch, right? You get cash in hand, right? Let's say it's a 1.7 or 2.7 gold chain, you get some 20,000 as loan or something. That is given as cash, or they pay out, today they pay out to your bank account or stuff like that. At that time it was cash, right? UPI had not even been launched. So we say we will give a card which your branches can stack. This is the story that we sold to IFL, right? Your branches can stack that because they have a big cash management problem. Cash management is not so well appreciated in India. Cash management is a huge cost. It's like a close to 3 to 5% cost of the cash that you operate with. Okay, so if you have to have 1 crore in your branch, they basically spend close to 3 lakhs in the lifecycle management. Okay, so that's the way, let's say. Okay, and nobody can estimate. Okay, to an extent they can, based on the data, they can come up with stories like last week of every month, everybody will have cash crunch, so they will come and place more gold. The first week of every month, everybody will have salaries and hands, so they will not pledge so much, right? That's the generic formula. But accurate data they never had. So they had to always have extra cash, buffer cash, or get emergency cash from some other branch and stuff like that. They had a lot of pilferage, of course, dealing with currencies. You will have somebody saying like I got stolen and all that, right? So they had, this was at about 3 to 5% of their business like cost. Okay. So we told them, you take a prepaid card from M2, which will be powered by DCB Bank, okay, our first partner bank, and then the prepaid card will have zero value. Whatever money you want to give to the customer as disbursement of the loan, load it onto the prepaid card and give it in his hand. And we did it over in India. Back in those days, card loading was a 1-day process. You give the money today, your card will have the balance tomorrow morning. Because the CBS was analog, or probably they did not have real-time API to call that, right? And no IMPS nothing like that, right? So we basically innovated there. We said, you call, I went to integrate the IFM API using my API, they were able to load money onto the card and in real time. The moment they say loan is approved, the prepaid card number is just required to be input, and KYC and everything else is taken care of. Because as a lender, we basically give more KYC than opening a bank account, right? Because they are lending money to you. And then gold is anyway there as a security, so they have no problem in loading this money on the card. And then the customer will be able to Instaget, which is basically a zero value card. 5 minutes ago, it got the money there. So it brought their cost down from 3 to 5% all the way down to probably about 100 to 200 rupees per card issued for IFL. And then it also earned money wherever the card was spent. Okay. And with the bank, we went and said India's largest, one of the largest lenders is ready to pilot this project. Okay, and we will offer the technology. If it works, you are just allow us a condition, give us a conditional approval of 5,000 cards by end of December 2015. We went to the bank in February and March. We went live in May. We gave a goal of 5,000 cards by end of December. But it just so worked, we ended up at about 50,000 or 60,000 cards by end of December. And till date we got to IFL. We have started covering a lot of stuff for them. Right? So long story short, when you go approach a big player as a small player, show them value, show them fitment, show them traction. Okay? And the traction probably will be projected, but you can actually say, give me a conditional approval for me to prove this. Right? In our world, it is a cards or accounts opened. In your world, it may be different.
Hey, thanks, Prabhu. That's like, I'm hoping that answered your question. Prabhu, thank you so much. If you can still hear me, thank you so much, and wish you all the best. Thanks for making it. I request the audience to appreciate Prabhu for making this.
Yeah. So any more questions, just pass it on. Maybe Sushma or Arun or anybody, right? I will definitely get it answered.
Yes, I will do. I'll pass the questions. If there's any more questions, feel free to write to us. We will pass it to Prabhu and he'll get back to you. Prabhu, we'll see you on the other side of the pitch. Thank you so much.
Thank you. Thanks everyone.
Yeah.